Good evening. Welcome to Admiral Markets. My name is Chris, and together with Nanette, we both are going to take a look at trading with bounces and breaks or breakouts. This is a webinar brought to you by Admiral Markets. And before we kick off, be aware that this webinar is intended for a global audience and may not be suitable for everyone. Please find out more information about that and other conditions and details at admiralmarketsglobal.com. Select your country of residence and contact an appropriate entity. Also, trading for exchange and global financial markets is considered high risk and may not be suitable for all traders and investors. Therefore, please seek the advice of an independent financial advisor for more information on that. This webinar is not advice and is for informational and educational purposes only. And by continuing watching this webinar, you agree with this disclaimer. And you're also aware of the risks involved when trading. Good. So a quick sound test. Is the sound all okay? Just a quick confirmation before I continue here. So welcome once again to Admiral Markets, and many good things on the website can be found, like a heat map, like analysis and content and webinar registrations, and also Supreme Edition, MT4 Supreme Edition with 50 plus extra features, ranging really from so many things, from alert manager to a correlation matrix. So a lot of good things to take a look at the website. Good. So I'm going to share my view first of all, and then pass it over to Nanette, and then he'll share his vision on trading bounces and breaks. Let's see. Sound is good. Thanks for all your confirmations, and good to see you, Jack, and Caitlin, BT, Enrique. Thank you so much for your confirmation. So the question: does the market offer 80-20 setups? And what I mean with 80-20 setups, I mean 80% probability that the trade is going to be a win, and 20% that's going to be a loss. So it's a high probability trade, right? So how many times, does the market really offer such a setup? Let's say each minute, or even 5 minutes, right? Every so often. Well, it's a rhetorical question because you probably know the answer. It's no, right? The market is not going to offer that many good setups at any point in time. The market is in the middle of a consolidation most of the time. And when it's in the middle of a consolidation, well, yeah, it can go up, it can go down, really can do anything, really. 50-50, and it's maybe even less than that because the market just kind of goes sideways, and probably it's less than 50 in fact. It's maybe from a theoretical point 50-50, but because the market goes so sideways that most of us will not hit our target. So it's just a mess basically. So when looking at the market, we know that there's a lot of noise and a lot of price action that's not interesting, basically. So for us, it's a matter of finding the moments that do have that high probability. It doesn't have to be 80-20 necessarily, but have that edge where we say, okay, this is worth trading. And many times it's not worth trading. So how do we know when it is worth trading? Well, first of all, before I answer that, let's talk about the 80-20 principle. It's a theory basically. We had a webinar on the 80-20 principle. I don't want to go into the detail, but it says that basically, 80% of the results come from 20% of the input. 80% output, 20% from the input. So if we use that same division, perhaps the market is trending 20% of the time. I wouldn't say that's a strange estimate. Maybe 80% of the time the market is ranging. So maybe the market is in the middle of the range 80% of the time. So the point here I'm trying to make is that with this principle is to use that theory to show that the market is kind of in the middle of nowhere many times. That's my point basically. So not many high probability spots. And well, this is maybe recent example where you see the euro dollar kind of making this triangle. And it's not, when it's in this triangle, not really that appealing perhaps. All right? So from that point of view, not interesting. Now, Caitlin is asking, okay, if the market is ranging that much, why are we not range traders, and why are some traders so concerned about the trend? And the answer to that is the range is more fickle. It's more in the middle. It's more unknown. It's more kind of I mean, sometimes ranges can be solid. Sometimes ranges can be very well defined. It can be very clear. It can be good tradable, and there's a decent space in those ranges. But a lot of ranges are messy, not that easily tradable, and it's easier to lose capital in there. And there's less space, less reward to risk potential. Trends, you kind of hold on. The idea is to hold on to the to trade a bit further and get that extra mileage out of that one trade. So if you risk little, but your reward is big, so it compensates a lot. Might not happen as often, but it's kind of that juicy trade that that we're waiting for. So avoiding trading, let's say trading in the middle, let's call it indecision spots. So it's kind of like trading in the middle or at an indecision zone. And what happens really when traders do trade there? Often enough, we're chasing the market, which means that we saw something that we thought was good. Let's say we thought our analysis said the euro dollar was probably going to go up, but we didn't trade it, and then we see the market going up, and then we join it. Right? Often that's chasing the market. We're too late. Or jumping the gun. We think that something could happen, but it hasn't happened yet, but we still trade it because we think it's going to happen. That's going too early. And when we're trading in indecision zones, often it's tied to those emotions, and we see these two things happen: too early, too late. So the whole idea of trading bounces and breaks is the fact that we're trading on our own terms, on our conditions. We're kind of saying like to the market, you can do anything you want, go ahead, because the market, is the market. It's just it's a neutral object. It's not there to it's giving us an opportunity to capitalize on trading. But we have to approach it, let's say, with a clear vision and our own moments. When you go to a negotiation table, you're not going there either unprepared, right? You want to be prepared and ready for let's say, the opposite side, right? So in a way, maybe not the market is the opposite side, but other traders are the opposite side. So we want to be prepared. So we want to trade on our own terms. And from this point of view, I like to kind of, it sounds maybe mean, I don't mean it that way, but kind of set up a trap for the market, or set up a trap for our own trading. And what I mean with that is that we wait for the moment that we get that edge and then trade. We don't want to be the trader that overtrades and that gets kind of in a way a bit sucked into a trade idea that really doesn't match what you were looking for, and you get tempted and you still take that trade. That's not trading on your own terms. That's just going with some kind of emotional flow. All right. So we want to find that moment when the odds are in our favor, when there's a good R2R and a good win percentage. Okay, so we'll talk about that now. Where are those high probability zones is the next question. All right, in my opinion, they're at key decision levels. And that will vary about how you trade. If you're trading in a range, you're going to be looking at tops and bottoms. Those are probably then the key decision levels for you. If you're trading trends, you're going to be looking at other things. You're going to be looking at channels, trend channels, moving averages, trend lines, and fibs, because those tools work very well in trends. And if you're trading reversals, you're probably going to be looking at divergence and indicator extremes, and also support and resistance to find those turning spots. So what is a high probability zone? It really depends on how you trade, and could be a mixture of these things. But it's basically finding a confluence on the chart where there's a high probability that price is going to react to that level. Okay, let me explain that a bit better. Basically, a trigger is that decision spot or level. The trigger is like, okay, that's the juicy moment where price has to show its, let's say, its true identity in a way. And what is it really going to do? Is it going to bounce? Is it going to break? Is it going to continue? Is it going to go in the opposite direction? That kind of stuff. That kind of information. That's what we get when looking at those levels. For instance, in this chart, we see two trend lines. Ignoring the one at the bottom, let's focus on the darker green and the orange one. And when price is in between those, these are the decision levels, the decision spots. Price is going to break to the upside, it can have a bullish rally. If it's going to break to the downside, it can have a bearish rally. It's a spot where price has to make a choice. It's at an extreme. It's not in the middle. It's at an extreme, and it's going to have to choose. It's going to go up and bounce, or is it going to go down and break? Is it going to go up and break, or is it going to bounce down again? Right? Well, what do I mean with that? Well, basically here, obviously, there is a choice. When price is there, it could break up or bounce down. When price is obviously here, the choice is obviously bounce up or break down. That's it. So each time the price gets to that decision spot, in this case the trend line, it has that choice: bounce or break, bounce or break. And the price is at kind of that decision level. Well, maybe I should have put the red circle here, by the way, okay? Because here we didn't really have a touch of the trend line, to be precise. I didn't realize that, okay? So each time price gets there, there is that kind of that moment that it's forced to make that decision. And that's the interesting spot for us. That's when it gets interesting, and not somewhere in the middle, not somewhere here. No. So in this case, we're waiting for the market to decide. And we want to follow the price after it has decided. Preferably, at least when you start out with trading, you don't want to predict the bounce. If you get more experience, as I've said in the past, it's a bit easier to take trades right at the decision spots, right at it. But you need to have a lot of experience with that, because maybe what you think is a major decision spot isn't. You have to get that practice in the analysis to understand, to really know that your levels are that, let's say, that accurate in a way. If you're not that sure, then let's say taking it at the level is kind of predicting that price will really bounce at that spot right away at that point. It's a bit more difficult. It's easier to follow price, or it's not easier, but it's, let's say, more recommendable for traders that start out and maybe have traded even for a while, to follow price, let the market decide, and follow what the market has decided, and avoid trading in that middle of nowhere. So step one, it's going to be do the analysis. Right? That means identifying the major decision spots. That means waiting for price to get there. So avoid those early birds and avoid guessing. When we identify the decision spots, we're going to wait for that. And that could mean, indeed, that there's no trade at this moment. That's okay, because price is nowhere, so we want it to go somewhere first. Then wait, when price gets to that spot, wait for it to break or bounce, and then we want to trade along with that market's choice. And we want to avoid that thinking for the market. We don't want to think for the market. We don't want to think, it's tempting to do analysis and then conclude something. Or not even do analysis and just make an assumption just like that. That's not, I think, the kind of like, the approach that will give consistency. We, as much as possible, want to remove the thinking that the market has to do something. It doesn't have to do anything. It will do and go wherever it wants to go. For us, it's just a business proposition to find the spots that have high probability and then trade along with the market wherever it wants to go. That's how we have to see it. So then after we do that, we can go to step two, and we can start making that trading plan, which is basically to decide whether to trade the break or bounce, or maybe even sometimes both. We can trade the break or bounce, because let's say it's a downtrend on the 4-hour chart, but an uptrend on the hour chart. So there's conflicting things, and when there's a triangle break on a 30, 50-minute chart, maybe it's tradable up to both directions. And then simply we just execute that but we execute the trading plan. All right, so now let me recap. So the name of the game: don't trade in the middle. Don't trade our thinking about the market. Establish those clear zones, to establish those decision spots, and understand that maybe that doesn't work right away off the bat. And that's a process that we will learn as we go along. Which decision spots do we want to trade? And then we trade those breaks and bounces. For instance, here, when I use moving averages, the long-term moving average is a very interesting spot for me. It's a decision spot. It's a break or bounce spot. You know, is it going to bounce off it back into this uptrend like here, or is price going to break through it? Now, when price is in a trend, at first we'll be only looking to trade the bounce really. And I want the moving averages, the short term, to really break. Most of the time, I want to break through it. The long term before trading the break the other way around, or the break to the opposite direction. A question from BT: by following price, will the candle move so fast that we're catching a falling knife? Well, you know, I think you can catch, in general, you probably can catch a falling knife at any point in time. You know, a lot of traders think the opposite. When you're trading fibs, for instance, and you take the trade right at the 61.8 fib without waiting for price to turn, that's what they call actually catching the falling knife, because you don't know if the price is going to stop at the 61.8. So let me give you an example. Otherwise, it's a good question, but let me show you what I mean here. You got 0 and 100, right, and the 61.8 somewhere here, and as price is moving up and it starts to make the retrace. Let's say you take it right at the 61.8. Price is in its fall. When you're trading in its fall, many of the traders refer to that actually as catching the falling knife. So what I'm saying is see the 61.8 as an interesting zone, but wait, for instance, for an engulfing twin here, like this, that respects that level, and then perhaps right at the candle close, or even maybe if you really want to go into details, a retracement of that candle, and you know, you still have a lot of potential space here, and you're actually kind of avoiding that sharp knife because you wait for a bit of reaction. Now, obviously, there's no guarantee. Price could always still go like this and then still break lower. So there's a choice: either put the stop loss tight and take a low risk, or perhaps even try to get out from break even here, or use a wider stop loss below the swing low and try to survive a potential dip and hope for the next rebound. I don't know, that's more about a fit pattern. But does that make sense? Does that make sense to you, what I just said? That if you actually trade against the momentum when it's going the opposite direction, that you know each spot of an entry has certain disadvantages in a way. Right? Nothing can be perfect. When you trade against the momentum, you got that as a disadvantage. Okay, cool. It's true though, you know, if you wait for, sometimes you could be unlucky, and if you have a huge engulfing twin like this, let's say, that really towers, well, then you might want to be careful and wait indeed for that retracement, for instance. Those are things that you want to keep an eye on indeed. Something to think about. So trading bounces at these decision spots. We can trade it without confirmation, right? I just was talking about that. Just like trading the 61.8 or even having a pending order right there. Same thing actually. We're clicking buy or sell right at that level. Waiting for that candlestick pattern that I just showed as well, in fact. And this is something different, actually waiting for the bounce. So let's say here, you see this price bounce after that long-term moving average, right? Instead of trading it right there, waiting for the bounce to happen, and this is a lower time frame. Now I forgot which one actually. The left is a 4-hour chart. I think the right is a 15-minute chart. So what is a break after a bounce? So let's take it step by step. One, without confirmation, would be trading it right here, right? Right at the moving average, for instance. The other one would be candlestick pattern. So not a clear pattern, but perhaps this bullish candle here, right there, with a close near the high. That could be, I think, a decent example. Okay, what is the break after the bounce? Well, often enough it's good to do that on a bit lower time frame, although even on this time frame it's possible. Look at this trend line here. The break after the bounce is when we get the bounce, the next break right there. You see that red line? That would be the entry. Or on a lower time frame, this trend line. You see that trend line? That's the break of a counter trend line after it bounces. So here it bounces. We see the bounce. We see a rally there, right? Right here. We have the green arrow. We see that rally off of that level where we expect the bounce. So we expect the bounce. We see the rally. That's all good. Then we see a pullback. And then the next kind of break of this resistance there, that will be the break after the bounce. It's the counter trend break. And we get the rally up to where the long-term moving average of the lower time frame. Nice trade. Break up to resistance. So in general, that's basically a break, pullback, continuation. So that's how we can trade bounces. Bounces at trend lines, bounces at fibs. Okay. We can trade breaks as well. We can try to hold on prior to the break. That means, let's say I'm trading this bounce here. And price is about to break through these short-term moving averages. Well, I'm already in the trade, so I'm holding on to a break. Well, if the break doesn't happen, of course, well, it's probably going to be a break-even trade. If it does, I'm going to get more mileage. So one way is to position yourself before the break even happens, right? The second would be the breakout, and a breakout of a candle high or low or fractal. The third would be a break, pullback, continuation as well, right? Classical break, pullback, continuation. Now, I think this is mostly known. So how do you know if a break is really happening? At what point do we see the bounce? At what point do we see a good break? And what I like to use are these couple of things. A candlestick pattern, the candle close versus the low and the high, and time factor. This is, all these tools are great. The moving average, the trend lines, the trend channels, they're good stuff. But sometimes we're going to get breaks that don't go far. Sometimes we're going to get pushes and false bounces or false breaks, and it's just part of the environment. It's part of the terrain. So we got to navigate through that terrain as good as possible. And I think using these things is that next step basically. It's, when we use candlesticks, obviously when price is breaking through a trend line, if there is a strong candle, if there is a candle close near the low, then there's a higher chance that that break is going to, be decent like this. I don't know if it's a break, but it's a good candle and you get follow through. Here, maybe even, right? Here's a support level. You get a good candle below it with a good, on that time frame, strong, sizable candle closes near the low, and yeah, you get the follow through. Nothing wrong with that breakout. Is it going to remove all false breakouts? No, but it's going to give a useful edge to trade those breaks and bounces. Now, time factor is a different thing, and if anyone's interested in that, I have a webinar from July. I can send you the link. Just send me an email, and I'll send you the link for that. And it's really a topic on its own. But basically, what you can see here is the fact that if not enough, a certain number of candles, like 6, as I use 5 to 6, don't break the bottom, like here. Well, then you're going to get into territory where this downside is probably over, and we're going to get maybe that bounce, like here. All right. So. And then when it doesn't continue for 6 candles, we're maybe going to be stalling. So it allows kind of to find those bouncing spots and helps with understanding that part. So got some time left. So let me take a look at some live charts. We can take a look at it together. And I got some questions here. Let me first write down my email, and then Ned is going to take over and show his part. And but first, let's see. Regarding the fibs, I do not understand why Nennet and I prefer deeper retracements instead of shallow retracements. Shallow means the trend is very strong, doesn't it? Yeah, true. Well, there's nothing wrong with shallow retracements. It's just that I would be less inclined to trade right off that fib and would want to see actually more confirmation, more information. So if price goes deep, I'll be, let's say, more willing to trade right at that level. Well, just because of the reason is that the reward is big and the risk is small. Let's say price, let me show you a practical example here. I put a fib on this pound yen and I took it upon this retracement and exited here for probably more of a scalping trade. I guess it's a 5-minute chart. I had a pending order there because it was a deep. I wouldn't put, well, maybe on the 5-minute chart I wouldn't mind, but let's say a pending order at a deeper fib is less desirable because just the risk is bigger. That's kind of the idea. Whereas a medium here or deep fib has tighter risk. So that's kind of the idea. But so any other questions? Is there maybe so this is how I look at the market. I mean, if you look at my webinars, I'm talking about those decision levels and what I'm looking for at those decision levels and which way I would trade it and which way I would wait for an answer. Let's take a look at the euro odd, for instance. Here was an example on Tuesday, right? Good. I said I was going to wait for this 4-hour candle to close, and if the close was good enough, close to the high, and this did qualify, then I would put a fib on that candle and wait for retracement to the 38.2 fib and take an entry right there. So you can see the trigger, basically, my decision was that candle. That was my kind of moment of truth. If that happens, I'm going to take a trade. And then I decided how to take that trade using the fib and using a direct order there. And price bounced quite neatly from that level and continued. That's an example of decision spot for me. That 4-hour candle was the decision spot as it reacts to this, basically reacts to this band. And if it did that, qualified for a bounce trade or breakout trade. Depends how you look at it. It is a breakout, actually, but I'm trading the bounce after the breakout. I'm trading the pullback after the break in a way, right? So you're going to see these concepts of break and pullback being intertwined depending on the time frame you're looking at. If that makes sense. The risk can be, question here, the risk can be just the next deeper fib, not the swing. Yeah, it can indeed, but it's riskier. Yeah, this trade was against the trend indeed. Yep, that's very true. I admit it. And let me put over here this one. But yeah, sometimes if I see reason to do it, I'm not always trading with the trend. I do like the trading with the trend the most. But in occasions, I sometimes trade with the trend. Sorry, with momentum against the trend. I'm not sure if it's working anymore, but anyhow, there was a momentum up, and I was looking for a 3-wave ABC zigzag up. So that was the reason, and it doesn't seem to be working. But this one was against the trend. Doesn't mean, you know, trading breaks or bounces doesn't always have to be with the trend. Apologies for the background sound. There's some car alarm going off, which is a bit annoying. Nothing I can do about that. Let's hope it stops at one point or another. But yeah, that was so yeah. You can trade bounces and breaks, and different levels, different directions, etc. All right, that I'm not sure which fib, Caitlin. You mean the pound yen? I think it was a deeper one. It was a 5061.8. Yeah, it was a pending order. I'm not a big pending order fan, but in this case it was, because on a 5-minute chart it goes fast, and I just thought that the setup was a high probability, so I went for the pending. That's really my criteria there. If I think it's if it's decent enough probability, I will go with the pending. That's funny, Jack. Yeah, yeah, good one, Caitlin. That alarm like that will certainly wake us up in case we're snoozing and we're missing something. I think everyone will be wide awake, be able to catch that trade without any problems. Oh yeah, your odd was a pending indeed, at any of those two levels. And I mean, I think in cases of doubt with a 4-hour candle like that, probably 38.2 would be better, because if aiming for the 50, there is a chance the trade gets missed. But depends from case to case too. So all right, let me that wraps up my part. Let me hand it over now to Nene. Talk to you soon.
Thank you, Chris. Okay, guys, now we'll continue with the presentation. I will also answer some questions, guys. So I will be using my examples on charts, and you will see euro dollar 1:11.55 break. You will see dollar CAD catching the knife, but this knife didn't give you any bleeding wounds. It gave you 50, 60 locked pips in profit. So as I said, I will use the example, and it still needs a little bit more power to go through 32.00 again. But now it's the end of day, so I'm not sure it will happen. But well, very often you know that it's not catching a falling knife. I repeated it many times in the past. Having a new spike can give you better entries, so that is why we also use deep fibs. And we had excellent data release from CAD. We also had excellent data release from dollar, but we know that Canada is in recession, so dollar is stronger than CAD, so we are looking for a deeper fib after the spike, 88.6 to buy. And actually, if you followed dollar CAD buy, you could have made a tons of pips on that trade. Okay, so one of the answers. Now let's see support and resistance. So as you can see, trends do not move in straight lines. We know that they zigzag in a general direction, forming progressively higher or lower peaks and lows. Okay, so usually when you see a trend line being broken, you can trade it by three different types, right? You remember what we talked about. We will repeat it again. So breakouts of the trend lines are traded by A, trigger happy trade, B, breakout retest, C, breakout pullback continuation. Okay, so that is why we usually see a pullback after the initial breakout and then continuation. Okay, trigger happy trade. Let's say that you see a triangle. Okay, triangle. And then suddenly the lower border of the triangle is broken. This, in example, is descending flat bottom triangle, which hints the charts continuing to go down because the price usually is contained within the borders of the triangle. Now, trigger happy trade. Immediately after a breakout happens, you press sell button and you are in so-called trigger happy trade. So that means taking the trade immediately after the price breaks lower support, usually by few pips. When do you go with trigger happy trade? Well, you go with, let's say, euro dollar today. You saw a huge momentum, and you were seeing a huge momentum in euro dollar. And I still hope that you remember my analysis. Euro dollar bullish about 1260, bearish below 1155. After the analysis, price spiked to 1318. Okay, so it was bullish right after, and then today it dropped below 1155. Okay, but it was huge momentum to the downside because there was ECB. I know we don't trade during ECB, but just remember that there was a huge momentum. there could have been another trigger, let's say great dollar news, which it was for today if you watch calendar. But 11.55 was broken, okay? And that is the aggressive way, indeed. But you need to, well, everything is risky, right? Do you have any guarantee in your life for anything? Okay, you buy a thing, you have 2 years, 3 years guarantee, excellent. But there is an object, right? Is there any guarantee that a car will not hit you when you are crossing the street? Of course, chances are not that high, but there is no guarantee. So I'm saying there is no guarantee when you trade. Okay, various people want to trade their own business, right? And there are a lot of guys who want to make money, for example, by opening a marketing company. Okay, do they have any guarantee that they will have enough clients and accounts to run a marketing company successfully? There is no guarantee, right? So this is your business, right? And when you invest some money in your business, there is no guarantee that it will be successful. But still, by using your knowledge, your charts, your mindset, risk management, you are hoping that you will be in profit, right? And that is the truth in every single business. There is no guarantee that you will be successful. Okay? No one can tell us, yes, for sure, in 10 years, you will be a millionaire. No, there is no guarantee. And when you take these risks, for example, Triggerhappy trade, that is why I don't like EA robots. Okay, I never ever put any expert advisor robot to trade on my charts, really. I don't like it, really. I don't like trades because I'm not sure that robot can be a successful investment. When there is market movement like this, for example, today, I think that various trending EA robots are totally, I can say, screwed, right? Because when price is falling down, a lot of robots will try to bite, making a lot of trades, unnecessary trades. And then suddenly from a profit, you see that your account is in a big drawdown just because a robot does not have a human mind. It does not have a gut feeling. It does not have a proper understanding of the market, right? There is no proper understanding of the market. And now, what would you do if you saw your account in a huge loss? And now, guys, remember, I'm a member of Forex Factory. I have my own trade in Forex Factory, a long-term member, and I personally know a guy who is now okay, so I'm not sure that I would tell you, but you're all our clients and friends. We trade together, so I will tell you. So 30K loss, guys. A guy is trading equity markets, and his contracts at the moment are $300,000 in a loss. Okay, in a huge drawdown. Yes, 300,000. Okay, 300K USD in a loss, and that happens. Okay, he's a good trader. I will not tell you his name, but he's well known in Forex Factory. He's a good trader. But as I say, guys, there is no guarantee. Okay, he's way under the water now. I just can't imagine. He has a big account. Okay, his account is really big. But guys, you know, psychological effect of suffering $300,000 in a loss is huge. Okay. Yes. Okay. So that is why we are here, both me and Chris, teaching you not just to make trades, successful trades, but also teaching you when you are in a loss, how to manage the loss. Because no matter how experienced you are, no matter how good trader you are, if you have a losing streak, okay, 300K, right? A losing streak, it can have a huge psychological effect, not just on you, but on your family, on your friends. And now what can I say about it? I don't trade equity markets. I know a lot about equities because I have a master in economy, and one of my favorite subjects while I was studying the economy, okay, I was really deep in that kind of markets, but I don't trade it because that movement, even though if I know that my trade will go in my direction, it's a huge stress for me at this point. I know that equity markets and trading equities can give you really, I can say, high profit potential, a lot higher than trading Forex market. But we need to make a balance, right? When we trade Forex market, somehow we know that our trades will not give us a psychological breakdown if we get in a loss, right? Okay, I'm losing 30 pips, even 100 pips if I lose. How do you know that? Because you are managing your risk. Okay, you shouldn't, when you deal with Forex, with the equity markets, if you open big contracts, it can be really disastrous. But if you open, let's say, $5 per pip, whatever, it can still be good, but movement can be a problem for your mind. Because movement on DAX, on SP 500, all those markets is huge, guys, believe me, huge. Okay, it's nothing like Forex market. So that is why I really prefer Forex market. I love to talk about equities. I love to, yes, it's great, you can make investment. I love to talk about it, but actually I'm afraid of trading it because I know myself. And when I trade Forex market, I'm totally relaxed. Even if I lose from time to time, it's not a problem because your risk is how much money you have. You need to know how big risk you will take. So it's all about you. Okay. Goran is asking. He wants a quick answer. If though S&P and Nasdaq are falling, do dollar rise or fall? Okay, I will try to make a correlation between dollar and those indices, but usually Dow is oppositely, let's say, related to euro dollar, and sometimes even SP is counter correlated with dollar. I don't have the time. This is different webinar now, but in the time I will explain it because sometimes when the investors are pulling out the cash, it can create a new cash flow in the market and currency may indeed rise, but it's a different story. There is no 100% correlation. Okay, so let's get back to webinar. Trigger happy trade. So that is why I was talking about risk. Trigger happy trade, it's breaking down lower bottom. Okay, you're taking the trade exactly at this point. When is the time to take a trigger happy trade? Only when there is a big momentum in Forex market. Okay, when there is big momentum and you see that there is a buffer zone or support, you can take trigger happy trade. You don't take trigger happy trades when market is not volatile. Never, guys, believe me. Because trigger happy trades can be successful only if the market is having strong momentum. Only then. Because otherwise it's too risky. Breakout retest trades, okay, you make something in between trigger happy and breakout pullback continuation. But breakout retest can also, it can happen, but you don't have a guarantee that a retest will happen, right? For trigger happy trade, you need to monitor the chart every second. If you see that euro dollar, I'm talking about euro dollar because obviously it broke through 11.55. I will use that example. So you need to pay attention to it when the price starts moving fast. London Open can be as good for trigger happy, but only if you draw these support levels successfully. Breakout retest trades it means that you're taking the trade after the price retest, let's say in this example, broken support or broken resistance. Okay. So once the price breaks out, then gets to breakout point if it struggles to go higher, or immediately after retest you enter the trade. And finally, breakout retest continuation trade, which well, they do not happen very often, especially if you day trade. It happens on strong momentum, and it happens on swing trade. Breakout pullback continuation was really my favorite. You cannot trade the market the same as you will not do you any good, because the only thing constant I just taking breakout pullback continuation, or watching MACD breaking through waterline and taking the trades when candle shows hammers. Well, a lot of systems do that, and a lot of systems suffer because of that. So breakout pullback continuation is good to trade on 4-hour time frame when you're having really a good trend. So breakout, then retest, and you know that if the price really breaks through this low, it will continue to go down. Okay, let's use dollar CAD. Okay, falling knife. You're calling this falling knife. I agree with you partially. Okay, and today's analysis of dollar CAD showed you 2 points of confluence, right? POC and POC2. Now what happens is, this is an inner trend line, right? And you see a multiple touches of this inner trend line. So this gives you the strength of the trend. You see that this was an uptrend and a retracement, and this is a swing. How do we call this? We call it bullish zigzag, right? Bullish zigzag. Up, down, trust pullback, trust pullback. So this is bullish zigzag. Time frame is 1 hour, so we are talking about intraday time frame. What happened is basically that we had very good news for dollar CAD, right? Okay, I will show you I will use Forex Factory calendar. So we had really good news for dollar CAD, and actually if you are watching dollar CAD news, we see that basically trade balance was minus 41.9, which exactly was almost 2 points better than forecast. And if you see that indeed previous reading was so bad, this means that really trade balance on dollar was excellent. This was excellent news. But at the contrary to dollar, CAD trade balance was also good. So now what can we expect? Okay, we expect that prices can retrace and give us a great trading opportunities. Okay, so because dollar is having uptrend, CAD it's okay, but you know, did you read my analysis? Okay, the main thing is that Canada is currently undergoing a recession, okay, because of low oil prices. Oil prices have been falling sharply through the summer and fall of 2014. As with GDP, oil prices have a significant impact on employment and overall economy. Canada's dependence on oil and gas is threatening, and that's the truth. It's reflected on the charts. So dollar CAD is in uptrend, right? What should we do then? We are using news-driven momentum to actually trade this, right? We are gonna trade this. And what happened is price went to POC, jumped like something like 15-20 points, and then bang, it started to break down and target POC2. And that is one of the answers to your question. After news-driven momentum, what did we say? How do we trade momentum candles? 61.8, 78.6, 88.6, or 78.6, 88.6. How do we trade NFP? 78.6, 88.6. Well, this is not NFP, but definitely the price is having a strong momentum. And, well, L5, 88.6, history of buyers here. What happens is you took the trade here and great, 50, 60 pips in profit. You can scale out, you can put your stop loss to break even, you can completely close your trade, because I already said if the price breaks through L4, 61.8, it will continue to go higher. I tweeted it just when the price hit L4. Okay, I did a tweet about price needing to break through L4, 61.8 to proceed to go down. So I gave you a clear signal here and there that you should definitely manage your trade. So that is why I don't see as a catching of a falling knife, because, well, guys, price has fallen 110 pips. It's a big retracement. And if you went with shallow retracement, well, that could be a big problem, because you would lose this trade. Okay, the price surged here and there. You would lose the trade. That is why I didn't put POC to be here. There is no confluence here. It's only L3. That at 38 is here, 50 is here, no confluence. But look at this, 61.8, L4, 88.6, L5. Naturally, L4 is very strong support, L5 is ultimate support. If price breaks to L5, well then, okay. But usually the price will respect it. So we are going with a trend, using news-driven momentum to get us a better price. Because trend trading is buying low, selling high. We are not buying it here. We are buying it here or here. We don't want to buy. We want to sell here. Okay, we are selling here. Okay, that is why I put always arrows like that. I'm giving you a cue that the price can go down before going up. That's why I always put these kind of arrows, giving you, keeping you from bad trades. Because I know that a lot of you, many of you really would love to get into a trade as soon as possible, and probably long, because you see that the price is going up. But that is why I'm making the cue a hint. Price can indeed go down, but if it goes down, be ready to buy it. Okay. Also, one of my charts, Australian dollar, 4-hour time frame. This is session recap revised setup. If you remember our session recap, the Australian dollar trade was selling here, something like 72.90, right? Well, next day I did revised Australian dollar setup and analysis, and this was trend trade and this was breakout trade. I stated here, possible breakout, okay? And if you took this trade, you could have made 100 pips. So I can say, even though GBP dollar was good, this was best session recap trade for this week. We had a loss on euro dollar, we had a loss on dollar CAD. I'm talking about session recaps. But for this trade, this was the best one, Australian dollar. And I said, even if you're still in Australian dollar trade, it should go lower, and it went to 769.77. Okay, so you trade breakouts here. How you would trade it, it's up to you. Triggerhappy, well, Australian dollar is really, it was really best for trading, along with even dollar CAD, I can say, because it's in a strong downtrend, and you just need to sell into rallies. Sometimes you miss the rally, sometimes you will get the rally, but at this point, it's just sell into rallies. So yeah, we had a sell here, it went down, and basically it was a trigger happy or breakout retest trade because price retested this part a couple of times and then continued to go down. Even you could have gone with a breakout pullback continuation trade. Okay, we are talking about, well, I did this 2 days ago, right? Well, or yeah, it was yesterday. I think it was yesterday or 1st September. Well, now I'm confused. Definitely, I will check this on the site. But I think it was yesterday. If I remember, let's see, analytics, technical analysis. And okay, I'm looking through the website. I think this was yesterday. Yes, yeah, it was very early in the morning, 7:38. Yes, this was yesterday set up. And well, because we had a loss on our session recap trade, I felt obliged to do another euro-dollar assessment. And what did I see is basically, while the price is above 1260, it was bullish. This is non-tradable area. This is called buffer zone. So we don't trade here. And below this, it should go down. And well, it happened. After the analysis, price went to, I think, 1318 or 1320. And then it went to test 1260 again. It was rejected a couple of times and then back into buffer zone. So buffer zone means when you see that I make buffer zone from time to time, we will be talking about this more deep in our price action trading school. So at this point, you should know that buffer zone is not used for trading, because when the price is in buffer zone, it can go up and down without any clear direction. I was very worried about this, and because of these historical things, all these things, and this trend line, I was definitely sure that when price breaks through 1155, it should go down. And if you remember, if you watch ticks and 1 minute chart, price came here and it was rejected a couple of times. But as soon as it went through 55, well, bang. It was a matter of minutes that the price went to 1120, and then even it went below 1100 today. Okay. And now, because NFP is tomorrow, well, I just need to tell you that we need to be ready for anything. If NFP comes out bad below 200K, I think that the price can really get back into the buffer zone. Okay, but still, only about 1260 is bullish, and still below 155 is bearish. So do not be surprised that euro-dollar jumps if NFP data is bad. Okay? So again, breakout retest, or breakout trigger happy, breakout retest. Even continuation was good. Of course, not on 4-hour time frame, but on 15-minute, 5-minute time frame, where you can see continuation more deeper. Okay. Again, breakouts of the triangle. 4-hour time frame, but obviously breakout. Look at this candle, then retest here, and there was no continuation when this chart was made, but continuation point at this example would be here. Okay, breakout, there was a retest here, and bang. So you see how triangle is broken. Now bounce, POC bounce. Okay, at this point price could go up. We have X cross here, we have 38.2, and yeah, you see where New Zealand dollar is now at this point. It even went through this. Okay, and that was a bounce. So when you're trying to get in a trade which is telling you that you should definitely play a bounce or rejection, then you need to have a good confluence. In this example, we are having X cross. Okay, we will be learning X crosses on price action trading webinars, price action school. Okay, so X cross 38.2, what is this? This is previous low, historical low, indicates that buyers were here. Now, because this level is broken, we are deeming and we are contemplating that this level is probably stuffed with now moment sellers. So historical buyers, a probable now moment sellers, X cross 38.2, POC, bang, we went down. And you are not catching a falling knife because price is rising. So effectively, you would think I'm catching I don't know, how can we call it when you swing your knife in the air? Okay, you're like a Superman, right? Trying to fly and catch a flying knife. Well, guys, there are no Supermen in Forex market. We are only humans, people, susceptible for mistakes, for successes, for all kinds of normal things. So we are only doing our risk assessment. So my risk was, okay, I will take this risk. I was thinking, I will take this risk, I will enter when price hits the zone, but I will place my stop loss probably somewhere around here. Because I want to trade, I want to make profits. Okay, that's the risk you want to take. Okay, but you need to know when you should enter market. You cannot sell it here, guys. I will be repeating this hundreds of times. Because you just don't want to sell lower unless there is a big momentum push. You don't want to do it, guys. You just don't want to do it. I explained, you're only taking trigger happy trades only then when there is a huge momentum. When you see that the price is going down, big momentum. This is support. Well, it breaks support. You see that there is momentum. Okay, you will get 10, 50, 10, 20, 30 pips. And you're getting out. That is hit and run tactic, right? Hit and run, okay. Fast in, fast out. Fortunately for us, other markets, ECN accounts are excellent for these kind of things. Excellent. I'm very happy with ECN. And every single trade I make, it's instant. And this is what we need for trigger happy trades. With these kinds of setups, you can go with standard accounts. Great, it doesn't matter. Even standard ones are good. But ECN has better spreads, right? So you won't always want to watch the spread when you're in a trade. You don't want to trade trigger happy with a pair which has 6 pip spread, right? Okay, 0.5 to 3 pip spread is good for trigger happy trades. Another example. Okay, are you catching a falling knife here, guys? Australian dollar. Do you remember this trade? Do you remember? It went 100 pips in a profit after the analysis. Okay? Are you catching a falling knife with this example? No, you are not. Because the price was here. It is a 200 pip drop. Even if the knife was falling, okay, even if the knife was falling down, well, it surely lost its momentum. It's a gravity pull, okay? Four major, oh, sorry guys, it was paused. Did you see this chart? Thanks BT for, you said that my screen was frozen. Did you see this example? I was talking about X cross 38.2 and breakout. Yes, good. So you saw this example. And now I was talking about this. Are you catching a falling knife here? No, you are not, because price dropped 200 pips. It's a gravity pull. In physics, now I will talk just a little bit about physics. There are 4 major forces in physics. Okay? Nuclear force, weak nuclear force, electromagnetic force, and gravity. Okay, gravity force is, we don't know a lot about gravity. We know formulas, we know, I won't bother you with figures, but we don't know how gravity is formed. Okay, we know that in our universe, everything is attracted by gravity. Even black holes. Around black holes, you will see a big gravity field which sucks in everything it reaches. But gravity pull is only 10 miles from black holes. Okay, it's not that big. But if you are caught within 10 miles radius of a gravity pull, you will be sucked in. Okay, now compare this to my analysis and my buffer zone. What did I tell you every single week? 10 pip to 12 pip buffer zone. This is gravity pull on your charts. You remember how I compared universe and physics to our charts. Now this is another example. This is a magnet for the price. Gravity is pulling this price here, and I'm talking about price gravity. It's just everything is connected. POC is here. Price comes here, and it's rejected from this zone. Okay, it's rejected, but the force was so high that it needed to hit the zone. Because if you're watching the history to the left, there was a strong buying here, and price was pulled by a price chart gravity to its POC, and subsequent it was rejected. Okay, because gravitational force or chart force, which is indicated by buyers and sellers in now moment, is not that strong. Because why? Because it dropped 200 pips, guys. Really? Are you serious? It needs to drop here to buy? No. That is why we are talking about confluence points. Same here, New Zealand dollar. I remember this analysis. It went here, it was rejected. Again, gravitational pull, price pull, towards historical buyers at this point, to the left. Okay? And now I will open live chart to show you final example, and then we can basically conclude this webinar. And this is another good example because I'm having dollar CAD here, guys. Okay, dollar CAD. I will zoom it in. This was dollar CAD live chart today. Now the price broke through 32. It should have momentum to go upward, but great, 60 pips from this point. Okay, zoom into 1 hour time frame and you will see it here. Look at this candle, guys. It signifies there is a strong buying. But the only thing now you see, it's a strong resistance at this point. But now it's 8 o'clock. So I'm not sure that there will be enough momentum, but still there is a momentum. Probably enough of a momentum to give us potentially a good bounce from this level. And yes, this can be a master candle here, but this is not master candle. This was master candle. Okay, yes, I know what you're talking about. Indeed, it is a master candle. Indeed, but you need to count later. But now we are not talking about next. We are not talking about master candle. Next resistance is master candle resistance, 32.15. But price needs to break through L4 to reach this, and it's going. You see, it's going up. It's another gravitational pull towards this price pull. This was the first rejection, 88.6, and bang, now it's going up. It's not, you don't be surprised. I was telling you that it could reject from this point and from this point too. And it's rejecting at this point. And this candle, we will see if it breaks. Well, guys, then I think there it will go more to the upside. Okay, guys, I think we are already over the time, and definitely, do you have any question? And if you have any questions, I will answer. But all of this, we will talk also on our price action webinars. I hope that I'm helping you with this analysis, and I always want to compare it to other forces in nature, okay, because these kind of things are making our world and our job that we do, okay? Everything is connected. Everything is connected, okay? So, did I lose all of your questions, or I cannot see it? I think that everything is clear. Do you hear me? Because I'm seeing a message, is audio okay? Audio is okay, right? Can you just confirm that you can hear me? Okay. Sound is okay, yes. Okay, so guys, it seems everything is clear. We are already over the time, so sign in for session recap. We had a good run. We had 2 losses, but we had a good GBP dollar trade, Australian dollar revised trade, so next week should be very good for us. And do not forget to sign in for Price Action Trading School and all these good webinars. So thank you for listening. Thank you for understanding. I hope that you made some tips today, and we will be here with you soon, guys. Cheers. Trade safe.